I think these are pretty solid results. I mean, the 66 cent is, versus 61, 62 expectations. A big part of that is credit, and not that credit quality improvement isn't nice, but lower credit costs, I think the market will kind of discount some. But I mean, net interest income was a little better than expected. Importantly, on the margins, I'd like to see a little better loan growth and probably a little better deposit growth. But the earning margin was pretty solid.
3%. Deposits were up 4%, right?
Correct. Which was, a little light of what we were hoping to see. But the net interest margin was better by a basis point. So it helps to kind of, I think, calm fears a little bit of some of the pricing pressures building out there that, we're actually seeing a little better net interest margin expansion than we were expecting.
Jeff, explain oh, I'm sorry, go ahead.
Nope, go ahead.
Explain what's happening overall with the bank stocks, because you would expect that as we've seen interest rates start to climb, that this would be a better time for the financials. That hasn't really worked to be the case.
Yeah, I mean, it's a very good environment right now for bank and kind of financial earnings, right? I mean, credit's probably as good as we've ever seen it. Loan growth's a little sluggish, but you're seeing some. I mean, banks are efficient. There's a lot of good things to like. What I think's weighing on the stocks here isn't so much what the current environment is, but what's the environment going to be next year? Kind of what are they going to do for an encore? What's it going to take to have another step up in bank earnings? I think that's what investors are wrestling with, because so many things are good right now. I think the answer is, or the potential answer is, economic growth. I mean, the banks are kind of a barometer on the economy because they fund the economy. The economy is really strong. History would suggest we should see loan growth. The rate kind of moves we've been seeing recently should continue. That should paint a good picture for earnings next year. But, we certainly haven't seen enough of that yet to date. So I think investors are a little skeptical that next year is going to be a whole lot better than it was already expected to be.
Although, having said that, Jeff, very quickly, for anybody who's looking for a recession, the banks aren't seeing it. If you look at the provisions for credit losses that we saw from Bank of America today, that we saw from JP Morgan, from Citi last week, they're all taking those numbers down. So if you're looking at that, it doesn't look like they see a recession on the horizon.
And importantly, the credit commentary is really good. We're not hearing, oh, there's some deterioration. We're hearing things remain really good. And I think the key with long interest rates going up is what's driving it. This is not inflation driven. This is kind of GDP growth driven. And QE factors into it some. But I think the higher long-term rates we're seeing are being driven by the right reasons.